Hello students, I am Aarti Kothawde, lecturer of Bookkeeping and Accountancy from Arihant College of Arts, Commerce and Science, Camp Pune. In the previous lecture, I have already started Introduction to Partnership and Partnership Final Accounts. I have explained you in detail what is partnership, and today we are going to learn in detail methods of capital account. There are two methods, fixed capital method and the fluctuating capital method. Fixed capital method is again comprises of capital account and the current account, and the fluctuating capital method comprises of only capital account. Now we will see in detail. See, as the name itself indicates, fixed capital method, the capital remains fixed in this method. The amount of capital of a partner remains the same at the end of that financial year. There is no addition or subtraction from capital during the year. And when this method is adopted, partners open a new account in the name of partner's current account, and all the related to capital adjustments are solved through the partner's current account. For example, drawings, interest on drawings, interest on capital, partner's salary, commission, brokerage, share of profit and losses are recorded into current account. Now if we will see the pro forma of fixed capital method, what the first transaction or first entry, see, by balance brought down. Second, by cash or bank account additional capital. It means when a partner brings the additional capital, then we pass the entry that cash or bank account debit to that partner's capital account. And if a partner brings any assets into business, then or into partnership firm, then assets account debit to partner's capital account. Then how to pass a journal entry. Just now I explained you. When additional capital is introduced by a partner's cash or bank account debit to partner's capital account. When capital amount is brought in by a partner in the form of assets, it means a partner brings the assets, then what comes in? Assets comes in. That's why we have debited assets account debit to partner's capital account, being additional capital brought in kind. Now, I will explain you the partner's current accounts. When the fixed capital method is adopted by the partnership firm, a new separate account is opened, that is partner's current account. And in this account, all adjustments related to capital are recorded. Partner's current account may show debit or credit balance. This you will have to remember. Number 1, drawings made by the partner in the current accounting year. Goods or any assets taken over by the partner. Interest on partner's capital allowed by the firm. Interest on partner's drawings changed by the firm. Salary, commission, etc. payable to the partner. And distribution of profit or loss of the firm. These all the entries must be entered in the partner's current account. Now, we will see the pro forma of partner's current account. Then, just observe by balance brought on. If it's a continuing partnership firm or it's a business, then whatever the last year's balance is carried down, that we are brought forward to this current year. Then by interest on capital, by salaries account, by commission account, by profit and loss account, it means share in net profit. Then to drawings account, to interest on drawings account, to profit and loss account, share in loss. If it's a loss, then we debit. And whatever the balances arrived, it is either debit or credit. So that is why here in both the sides, in the pro forma, we are observing the balances carried down. And remember, students, whatever balances are carried down, you have to brought forward in the same sheet as to balance brought down after the totaling. Okay, now we will see whatever I have explained you. Now we will see in the form of journal entries. Interest allowed on partner's capital. Interest on capital account debit to partner's capital account or current account. Means what? Being interest due on capital. Then profit and loss account to interest on capital account. Being interest on capital transferred to profit and loss account. Now students, you have to remember, the partners invest in the business, means it is the capital, and the business giving the interest on that capital, so it becomes the expenses from the point of view of the businessman. That is why we have debited interest as an expense to the profit and loss account. This again you will have to remember. The next, salary or commission allowed to partners. Salary or commission in partner account debit to partner's current account or capital account. And again, as both are the expenses from the point of businessman or business, then we are debiting profit and loss account and crediting to salaries and commission account. And narration will be being salary or commission transferred to profit and loss account. Now, cash or goods taken over by the partners for their personal use. Drawings account debit to cash or goods account. Being cash or goods withdrawn for personal use. Then partner's current account or capital account debit to drawings account, being balance on account transferred to current account. Now the fourth entry will be interest charged on drawings of the partners. As we know, when a partner withdraws cash or goods for his personal use, then it is the drawings. Okay. Then if the interest is charged on drawings, then we have to debit partner's current account or capital account to interest on drawings account. And again, interest on drawings account debit to profit or loss account. As interest on drawings account or interest on drawings is an income from the point of the business, that is why we are credited to profit and loss account. Then transfer of net profit. Profit and loss account debit to partner's current account, capital account, being profit transferred to partner's current or capital account. Always remember, if there is a profit, then we debit profit and loss account and credit partner's current account. Distribution of net loss, and when there is a loss, then we debit partner's current account or capital account, and credit profit and loss account. In the next slide, we will see the fluctuating capital method. Now, under fixed capital method, the capital remains fixed or the same. But here, in this method, amount of capital balance changes every year. Fluctuating means what? Changes. It is called as fluctuating capital method. In this method, the partner's current account is not open. Hence, all the adjustments are solved through capital account only. Following are the adjustments related to capital. Initial or opening balance of capital. Additional capital brought in by the partners in cash or in kind. Salary or commission payable to partner. Interest payable on capital balance to partner. Drawings made during the year and interest payable on drawings by the partner. Withdrawal of part of the capital by the partner. And the division of transfer of net disposable profit or net adjustable loss of the firm. If we will see the pro forma of fluctuating capital method, whatever I told you, you just remind by balance brought down, by cash account means if a partner brings additional capital, then we debit cash account and credit to capital account. Then interest on capital account, by salaries account, by profit and loss account. Observe one by one entry. Then debit to drawings account, interest on drawings account, to profit and loss account, share in loss, and to balance carried down. If we will see the difference between the fixed capital and fluctuating capital, as under fixed capital, again I am repeating, the capital remains the same, and under fluctuating capital, the amount of capital changes every year. Is that clear? Now, there are three important notes you have to remember. Number 1, current account balance may appear in either side, that is debit or credit side. In the absence of any instruction, the capital account should be prepared by fluctuating capital methods. And the third, interest on loan of partners is treated as a liability, so it is credited to partner's current account. But when there is no current account and partners are maintaining fluctuating capital method, then interest on loan of partner is credited to partner's capital account. Now the students, before solving the problem on final accounts, we should practice or we should read this theory and remember. And in the next lecture, we will see the partner's final accounts. Is that clear? Go through all this theory. Thank you very much.